good morning and welcome to another segment here of the News Talk WTIM morning show, heard here on the Big 870 AM all across central Illinois, 96.1 FM in Christian County and 107.5 FM in Shelby County. Joined in studio here this morning with Steve Henry. He is the WTIM investment professional and also with CSH Investments. And Steve, I want to thank you for coming on in this morning.
Thanks for having me this morning.
And always a pleasure to have you in here. What are we talking about here today?
Well, there's a number of things we could talk about. I kind of want to go talk about a couple different topics today. The first one is, we're kind of seeing the stock market really take off here the last since the election, and I think that, and I've spoken in the past that the low interest rate environments have spiked prices of stocks. Stock prices interest rates are extremely low. That makes stocks very attractive. Stocks do well when rates are low. And to such an extent that today the market on a historical basis is very expensive. Now, I know I've talked about this before, and I think I need to continue talking about it because I want people to understand that these are things that happen over a period of time. They don't, the market's not going to shift just like that tomorrow.
Right.
It can, but these movements take months.
We're talking greater
sometimes
trends.
Years.
Right.
So sometimes these trends last a lot longer than what you believe they will last. Markets, I forgot who said it, but markets, someone said that markets can stay more expensive than you can ever believe, and they can go lower than you could ever believe. And so you just never know. But, on a historical basis, let's just kind of look and see where we are versus history. Right now, we're in probably one of the three most expensive stock markets ever, since they've been keeping. 1987 was prices were, 1999, 98, 99, stock prices were actually higher on a PE ratio basis. And they were actually higher before the Great Depression in 1929. So it doesn't mean that the history will repeat itself in the exact same way, but I do believe that history rhymes. It doesn't, you kind of see the same things happening over and over and over a period. If you've followed financial history, and which is another topic, financial history needs to be taught in colleges. It's not, but that's another thing altogether. So we've got a very expensive market, 22 times earnings. It hasn't been that expensive. I think it was about that before the 1987 crash of 1987. Number two, investors seem to be pretty complacent. They seem to be not really paying attention, and we can measure this now. So we have a measurement called the VIX. And this is basically it's a volatility index, and it's been around for about 23 years. And the VIX shows you the volatility of the market, and in general, if the VIX is very high, there's a lot of volatility. Prices are moving all around. Investors are kind of worried. They're selling. They're buying back. There's a lot of volume.
It's not really stable.
Correct. But right now, the VIX is at a 23-year low. In other words, it's flat. So in other words, the VIX is kind of a fear index, right? It's kind of, the higher it is, the more fear people have. The lower it is, the less fear have. And today, less fear people have. Today, it's at the lowest it's ever been. Those are two things that kind of would give me caution when you look at them together. High valuations, low volatility. The volatility is extremely low. So there's a total absence of fear, it seems like, in the markets right now. Number three, and this one, I'm pretty politically apolitical. I'm probably lean more to the libertarian side, and I don't like to get into those arguments because I think most of the time people really don't know what they're talking about, including the people that are in it. So, but number three, when Trump was elected, I think there was a lot of people. He talked about his economic agenda, and I think there was a lot of people that thought that was very pro business, and it was. And so, one, he talked about $1 trillion in infrastructure spending, which we probably need, right? And That's a big number, and if that came to fruition, that would really spur it. Would, over time it would be a tailwind for the economy. And two, huge tax cuts. Huge corporate tax cuts could make a big difference to corporate earnings. And it seems like his agenda is kind of in trouble. And so I think and this really isn't being valued into the market. And I think the market it's being valued as such that there is no problem that these things are going to happen. And so I think if you take those three things together, I think you can make an argument that, market's pretty expensive today. And you probably want to, when no one is cautious is probably when you want to be cautious. And when everybody is flailing about with their arms and running around and bouncing off the side of the room, you probably want to be the one to remain calm and start buying.
Right.
Because people are losing their minds.
Because it seems like, that's one of those things that happens, whenever the market seems to be having issues, you hear about,
it's extreme. And we could probably do a series of shows on just the psychology of, and the great investors all say that if you can master the psychology, and it's very difficult, that you'll do quite well over time. And history shows that that's the case. If you can just ignore what's going on around you and just, pay attention to what is really important and not whether your neighbor is losing his mind or something, that you'll do very well over time.
And you'll hear about that a lot, too. You hear about these big-time investors who will be doing almost the opposite of what it seems like everybody else is doing. Everybody else is
and I like to kind of follow those guys and see what they are doing. But then the thing is, you have to realize they make mistakes, too.
Right.
And so, you're seeing people all over the map as far as, the great investors. Some of them, many of them have spoken. Some of the best value investors in the world over the last couple of years have been really cautious of the market. And there's a couple that have kind of turned around in the last few months and said, well, maybe I was wrong. And, that to me, I've seen this episode before, and so I just think that, I talk about having a plan, and I think most people just don't really have a plan. I think they're kind of just letting everything ride, and whatever happens, and they don't think that could, something bad could happen again. And, like I say, there's a lot of problems in the world today, and of course, there always are, and markets go up over time, and that argument, but again, if you would have invested at the peak of the market in 1973, it would have been 14 years till you got your money back. I mean,
right.
It took a long time. I mean, people did not invest in stocks after the market crashed in 73 and 74, and they were scared to death. And if you said that you should be investing in stocks, you need to duck because they would throw something at you. It was not this was not a good business to be in. And that's when, Buffett, a lot of the great investors, Buffett included, laid the groundwork where he said he tap danced to work every day. While everybody else was losing their mind, he tap danced to work. And he kind of laid the foundation for what Berkshire Hathaway became, and laid the foundation for what the icon that he became. And that all happened when nobody wanted to buy stocks in 1973, 74, 75. 76.
He was the guy
78. It went on for a long time.
Yeah.
And most people cannot take that type of, they just don't see the value that might be there. And his partner, Charlie Munger, is a great example. I mean, Charlie Munger started a fund about that time period at the top of the market. And the first year he was down 50%. And the second year he was down another 30%. Now, how many people you think that would stay in that fund? Charlie Munger's probably, you can argue that he's got a better investment record than Buffett, right?
Right.
So the people who invested with him are billionaires. So the first 2 years were pretty bad.
Got off to a rough start.
He said, that doesn't tell me anything. The fact that my stocks are down does not tell me anything. All it tells me is what the psychology of the market is, what's happening around the psychology of the market. Our assets are worth multiples of what they're trading at today, and that's why we're going to stay the course. And he did, and obviously it worked out very well for them. So anyway, and and there are alternatives. I mean, what we're doing is, and I talk about people having a plan, is that it's not terrible, especially if you're in a IRA or you got a 401k, to take some gains. And I know people who after 2008 just got totally out of the market.
Right.
And obviously that's an extreme. You don't want to ever go to extremes, I think, in investing, because there's a lot of unknowns. And that was an extreme, and I think they're really kicking themselves now that they never got back in the market. So
I imagine.
But there are a lot of those stories. So they get scared and they don't want that feeling again. That feeling of dread.
Definitely.
So have a plan of if you're nearing retirement or in retirement, have a plan for what you would do in such a scenario.
Wonderful. And
a long period where that
right.
scenario plays out, which is more excruciating probably than a one-day fall, right?
Mm-hmm.
A 14-year period where you don't make any money at all is excruciating.
Right. And we'll talk about, of course, more on this subject and more coming up next year on this segment of the News Talk WTIM Morning Show. You can stream online now at TaylorvilleDailyNews.com.